Thank you for joining us today for our November version of Coffee with Forethought. Of course, your monthly guide to markets and smart planning here. Just giving a second for everybody to join us before we move forward. But while we do that, just a quick reminder about our disclosures here. Everything that we talk about today is not financial advice. Please consult any of your financial professionals before implementing anything. This is just for educational purposes only. And also, quick reminder, we are going to be doing a Q&A at the end. So at the bottom of your Zoom screen there, you should see a Q&A button. We'll be monitoring those questions as we go through the webinar today. We'll get to as many as we can at the end of our webinar. And if we don't get to your question during our live meeting today, we'll make sure to have somebody reach out to you and get that question answered for you. As always, I'm Joel Johnson, our Director of Financial Planning here at FourThought. Happy to be with you for this November version and joined by Jake MacFarlane, our Senior Research Analyst. Happy to have him with us as well. And again, one more reminder about that Q&A just before we move on. Love to hear the questions as we go through here. So please, the more participation we get, the more fun it is for Jake and I, because if we just keep hearing ourselves talk, it's just not quite as much fun. So please, but we strongly encourage you to participate there. So Jake, lots of things happened in October. We've got a lot of material we need to get through today, so we're going to go ahead and dive right in. But three big topics we want to make sure we talk about today. Rate cuts being the big one. We'll touch on the economy, what's going on there. And I know you've been busy with the earnings season, and so we'll hit on some highlights for some of the companies we've been watching. But why don't you kick us off with the big highlight of the month with what happened with the Fed and rate cuts?
Yeah, absolutely. It was a month to remember in that we had a policy decision here where the Fed decided to go ahead and reduce rates. And also, the Fed's got a couple different things that they can do to sort of adjust market expectations. And of course, the most notable is going to actually be changing the interest rate or the Fed target rate, which was reduced by 25 basis points. The other thing that they can do is sort of how they're talking about the decisions that they're making. And one thing that definitely spurred the market forward a little bit was this expectation that we were going to get another cut in December. However, Fed Chairman Powell came out and said, as a quote is on the screen, that that's not exactly a foregone conclusion. And so we did see some prices adjust from that point. But certainly we had a positive momentum in the month of October, and a lot of it driven by that rate cut decision.
Yeah, I think going into that, of course, the market was almost guaranteed of that rate cut decision. There was a little bit of conversation about just how big it was going to be. That was kind of an ancillary discussion going into it. Almost everybody expected that quarter point. But like you said, Jake, that comment that he made, if you've ever listened to one of their meetings, A, it's great if you're trying to go to bed early one day. But B, they're very particular about the language that they're using when they're going through that. And so for him to come out and be so forthcoming or adamant that we're still looking at data here, don't just assume we're going to continue to cut from here. And you saw the market react to that. And so when we look at what the market did going into that rate cut, again, we expected this one, but there was a very high probability of another cut in December. We expected this to kind of continue for the next couple of months or meetings at least. What we're showing here is the rate cut probabilities over a period of time. So that dark blue on the very left is where we are today compared to where we were just a day ago, a week ago, and then also a month ago. So the two that you're going to want to look at here is the far left, that dark blue where we are today, call it 70% chance of a rate cut in December. That's down from an almost 100% probability of a rate cut. Let's call it 95, 90% just to be safe, that we were looking at just a week before that happened. That's how drastic of a change just that one sentence can make. And I think there's some reason for them to say, hey, hold your horses here. And we're going to get into some of that data in a minute. But then the other thing you'll notice as well is that when we look at the size of the rate cuts or any cut at all, that's that second set of columns there. That's assuming we don't get a rate cut anymore. And so that changed drastically as well. And so things are definitely moving as far as the markets go. And you also see that when we look at what's called the dot plot. And Jake, I'll let you walk folks through this one. It's kind of a fun chart to look at, but this is where we are today as far as what those Fed governors are thinking.
Right. So basically, each dot is going to be a projection, right? So this is where the participants assess and expect the overnight lending rate from the Treasury to kind of land at. And typically, we see kind of there might be some outliers, some participants who just see the data kind of like a different lens, right, than others, and so typically we see some clustering where a lot of people are kind of feeling the same way. And then there's maybe one or two stragglers. But as you can see here, it's very interesting, not only in 2025 or even in 2026, but kind of over the next 5 and even the longer run. There's almost no consensus here with participants, being on the same page of where they think that rates are headed, at least in number of cuts, if we get cuts at all. And so that's really interesting. And again, right, the Fed has always said that they're very data dependent, and so they're going to adjust as the data comes in, and they're able to reflect on that. But Joe, I'd like to get your comments on this. I mean, to me, there's just a lot of data and a lot of noise that is kind of impacting the data that makes forecasting much more difficult now than it has even been in the last couple of years, where you could see that their projections weren't exactly correct, and that they seem to always be a little bit late on things. And even going back to COVID, when they just called that inflation transitory, right? Now we have tariff concerns. We have an economy that's still growing, but it's kind of slowing a little bit. And then, of course, we have kind of the AI boom and immigration, and so there's a lot to get into there in terms of labor and productivity and kind of what that effect will have on the broader economy. So right now, there's not a lot of consensus, and we'll kind of see what happens as we move through the month of November. We're not going to prognosticate, where we think exactly that rates are going to head. But right now, we have seen over the last week or two, the probability of an additional rate cut in December has fallen off a little bit.
Yeah. Yeah. A couple things that stood out to me, kind of going back to Jerome Powell's comments regarding the tariffs. He actually did mention it during his speech, and I think it's kind of a pivot also in how they viewed the tariffs, which was it really was more of a one-time pricing adjustment in the economy. They think that that may have already worked its way through. Of course, it's still an evolving situation, but maybe some of that's already starting to show in the data, which would actually be good news because when we get to it, the data actually doesn't look that bad. But the two things that stand out to me on this chart is if you see that red dot there, that's the average rate that's the meat. Yeah, that's the average rate that people think the overnight lending rate is going to be, and that's what's tied to credit card rates, car loans, all of that. You're going to notice it does not really dip below 3 for very long. It is right now in 2026, but then it's back above, which means the Fed still thinks we have a very strong economy. The Fed really only has two tools in their toolbox, and so they want to keep as much dry powder with interest rates, keeping them where they need to be. Because if something does go wrong in the economy, whether it is just regular cycles or if it's something unrelated like a COVID pandemic, they need to have interest rates to be able to cut them in those types of situations. So if you're sitting on the sidelines, especially people out there looking to maybe look to move homes or anything like that, they're not seeing rates coming down very drastically from here, maybe 0.5%. So unless something drastic changes in the market, I wouldn't be holding my breath for that. So that's just really, that's what I see when I look at the dot plot. But again, when they say that they're data dependent, the reason that I don't think that they're planning on any more rate cuts is when we look at the actual data, it's pretty good. And we can run through each of these, and there are some yellows here still, and you do hear some one-off scenarios, and Amazon's cutting jobs, and so we're not talking about individual situations, the government shutdown. We understand that that has effect on people's individual lives, and we understand that. But when you look at the overall economy here, we're actually running at a pretty good clip almost across the board. The couple areas that we have been watching, namely housing and the consumer, housing is still a little bit wonky, but that's going to continue to change as interest rates come down, I think. But then the one that we've been talking about for the last few months, Jake, was really the consumer. And I don't know about you, but it looks to me that it's actually kind of working its way out. Like I said, those tariffs may be just a one-time pricing increase, but from there, we're back to spending.
I agree with you. I mean, you look at the data here, and to your point, right? Nothing in red, right? So no real oh man, we gotta sound the alarm. There are some pockets of data, right, where it could be better, of course. I think if we look at GDP for the Atlanta Fed, they have a kind of like a predictive model that is used to forecast the next quarter's GDP, and that still looks strong. However, as we get into 2026, the GDP is supposed to be kind of drastically under 2% from a real GDP growth standpoint, but still positive. So that's still good, just not great. And I think the number that stands out to me, which again would sort of put the ball in the Fed's court to sit back down and not pursue an additional cut, would still be inflation. I mean, we're still running in the high twos. We are still above their stated, 2% target. We're kind of approaching that 3% mark right now. And of course, we'll see if the tariff impacts, if they are just a one-time price adjustment and that's already in the data, then we might see some pullback there, which would be great. And then the Fed can kind of not worry about inflation and focus on the labor market. And that might, lead us to another cut. But if that inflation numbers tends to be kind of still sticky around there and it's difficult to kind of work that out, then that could be more reason for the Fed to just sit where they're at right now.
Mhm. Yeah, and the one that sticks out to me that we'll kind of touch on real quick is also the yield curve. So one of the things that people like to pick out is always that 10 to 2 year spread. And you hear all the time that there's an inverted yield curve, and that means there's going to be recession. And that's not necessarily true. But also when you look at where we are today, we actually don't have an inverted yield curve. Right now, the 10 year is a little bit above the 2 year. And when we look, and this is what that looks like. Yeah, if there we go. This is what that's looking like today. So again, when we talk about Fed rate cuts, they only control that very short end of the curve there where it looks very hilly. They only control that portion. That is all Fed driven. After that, it is purely market participant driven. And so we actually have a relatively healthy yield curve towards that back end. Now, you're getting higher rates on short-term money than you are on that longer-term money. There's a bunch of things that go into that I'll let Jake kind of walk through a little bit there. But when you're looking at this from an overall perspective, nothing really major has changed with those market driven rates, even after this rate cut. This one was baked in. Rates reflected that. We've sort of stabilized. There's been a little bit of movement. But from here, unless there's any major adjustments from here, if they don't cut at the next meeting or if their language becomes more hawkish or more, that's where you're going to start seeing some fluctuations. But for now, we're kind of in a holding pattern.
Yeah, I think if anything, I mean the yield curve is definitely getting to a more normalized environment, right? Where we would, expect that locking your money up in a 10-year loan or 20-year, 30-year loan would earn you a higher return than just a, 30-day loan or anything like that. That does signal sometimes that something's not quite right, right? And we need to make some sort of adjustment there. And certainly, what the yield curve is projecting right now is probably on the short end needs to probably come down over time a little bit. And we're not really seeing a whole lot of risk coming into the right tail of the yield curve, right?
Mhm.
That 30-year, which is a healthy thing. But overall, I agree with you, Joel. I think it's been certainly I'd been priced in that we got that last cut. Now, it's still seeming like greater than a 50-50 chance that we get another cut. And I think really at this point, if we still get status quo, a lot of the news and the volatility that comes in the market is going to be more about the individual companies than it kind of is, the broader economy or, economic decisions that the Fed's making.
Yeah, could not agree with you more. And of course, us as fundamental investors, that's what we're always looking at. And just one more thing on interest rates here before we jump into those earnings and start talking about the companies and what we're seeing out there. And I know you've been busy with that. Just to check in on what those, again, market-driven interest rates are doing as far as mortgages go, because you keep seeing it. We're cutting interest rates. Great. That means loan prices are coming down, and they are. But again, not nearly as drastically or as quickly as what you're going to see in the Fed. So if they continue to cut, we do expect these to come down, but we're probably getting a little bit closer to a floor than we might have thought just a couple of months ago with all the talks of a struggling economy that we're just not seeing. So interest rates continue to come down. That should unlock housing. That should be good for that part of the market. But we'll continue to wait and see. And again, mortgages are more tied to the 10-year than what the Fed is doing, but of course they are linked somewhat. So with that, Jake, let's jump into earnings here, and we will start with our earnings scorecard. So as of today, as of today, about 64%, maybe a few more have reported. But what are we seeing thus far, Jake, out of the companies that have reported?
Well, certainly we're seeing that names that are in the majority of sectors are kind of above 80% are beating their revenue expectations, right? So this is where either management is guiding or also Wall Street analysts that are covering these companies. They set their expectations for what this company is going to make in revenue on a quarterly basis, and the vast majority of companies are meeting that and then exceeding it too, which is great. But also, it's funny that you'll see a lot of these companies, they'll beat the expectations and they won't be rewarded for it. And it's that tells me that, hey, analysts are expecting them to make this, but the market had an even greater expectation. So just because that they're beating these expectations doesn't necessarily means that these stocks are having these great enormous leaps post earnings. But overall, we saw the equity markets extend their rally, a lot of that being driven by more AI enthusiasm and also some easing policy tone that we just talked about there. But interestingly enough, as we look through these sectors, the one that kind of jumps out to me, of course, is within information technology. I mean, almost at a 95% clip of companies in the S&P 500 that are beating that mark. And if we compare that sector to just the broader S&P 500, which is at 79% are beating expectations, we start to see how resilient those companies have been and how well that they're doing from a fundamental standpoint. If we look at some sectors that are kind of under that S&P 500 average, real estate by far being the worst there at only 68% beating expectations, and communications not too far behind at 69%. And remember, like these management teams, they're putting out their expectations and they're not trying to overpromise and underdeliver, right? It's never good to have some news come out during earnings that, hey, we missed the mark, and the market tends not to react too nicely to that. So sometimes you try to pad some wiggle room there to be able to beat expectations. So to see couple sectors fall below that, something that we have to just pay attention to. But broadly speaking, from a revenue standpoint, these companies are having very resilient earnings results.
Yeah. Yeah, and of course, revenue being the top line on that profit and loss statement, right? And then there's a whole lot of things that are going to happen between that top and that bottom line, and both are just as important. And so when we look at the bottom line number that these companies are reporting, it's an even better story compared again just to expectations, which means that we were kind of going into this with some, mild expectations of what these companies were going to be able to deliver us. But again, you're looking at almost across the board where we're beating on that bottom line as well. So everything that we're making at that top line is falling down to where we want to see it. And so what you see on this chart, again, we've got the green and the red. So green, we beat expectations. Red, we missed them. But then yellow is meeting those expectations. And so this is exactly what you want to see. If we saw a lot more red across the board on this, we'd be much more concerned. But with almost 83% beating on the bottom line, that's a very healthy stock market, just generally speaking. Now, like Jake said, you're going to see some winners and some losers. We call it priced to perfection. So going into these, whether or not they beat their earnings or not, it goes a lot farther than that. What they say in the earnings call, what their expectations are moving forward. That's what you'll see with the stock price movement the day of earnings. And we've seen a mixed bag there. So this right here is revenue surprise at the sector level. And really, it's been positive, generally speaking. Ironically enough, in the most boring parts of the market, it's been more positive. You've seen better surprises out of utilities and healthcare, but where we've been more perfectly priced, it's been much more muted because a lot of the companies were priced to perfection, didn't meet every single little checkbox that the analyst was looking for. And so the reaction was a little bit more muted because we were already going into it expecting so much more. So, Jake, I don't know if you have anything else to add to that portion of the, but it's been really good earnings thus far from the companies we've seen.
Yeah, I mean, I think just to close on this topic here, the first thing that kind of jumps out is not even one sector had negative revenue surprise over the quarter. And that's not exactly normal. A lot of times even you'll have a couple sectors lead, but then a couple sectors are just really going through kind of a tough time and
Mm-hmm.
have negative surprises there, maybe two or three of them. So that right there just shows kind of a broadening out, I think, of from a revenue and from an earnings standpoint over the quarter, which of course is good. The second thing that I'll point out too is if we look at the earnings per share growth or the profit growth for the quarter right now, it's just under 11%. And so that was one thing that we were really paying close attention to this year specifically, was that we saw Wall Street analysts broadly, they expected the S&P 500 to grow profits in the double-digit range, and they also expect that to happen next year too. And we looked at that as maybe being a little too optimistic. Right now, we've been pleasantly surprised on that front.
Mm-hmm. Mm-hmm. Speaking of pleasantly surprised, talking about the S&P 500. So one of the things that we have been talking about for I don't even know how many years now, Jake, has been concentration in the S&P 500. Of course, we know it's a market cap weighted index. That just means the larger the company, the larger the weight inside of the S&P 500. And right now, correct me if I'm wrong, I think that the top 7 names are plus 30% in the index. That
Right.
is a huge concentration compared to historicals, but they're great companies. Netflix, Apple, Microsoft, it's all the companies we know and love. But in a healthy market, we like to see broader participation. The technical term that we like to use is breadth. Who is participating in the markets? And last year, it was a very narrow market. Those Mag 7, what we call them, they were beating everybody. They drove all of the performance in the market. Year to date, we've actually seen a little bit broader participation among all of the other 493 stocks that make up the S&P 500. So what we're seeing here is you see that red line, that is still the top 7 names. So they are still the best performing group as a whole. But then the yellow is the S&P 500 by itself, and then that green there, that's the other 493 companies. If we pulled this chart up for last year, it looks very different. It's telling a different story. So we're actually seeing a much healthier market year to date, and hopefully through the rest of the year, than what we had last year, which is just more reason to be optimistic. Now, we're not buying the market, we buy individual companies. So we're going to talk about a few of those in a second. But Jake, you got anything to add to the breadth we've been seeing this year?
Well, I think one thing that's interesting is in the first quarter or so of the year, right, where that red line, the Mag 7 stocks were down over 25%. I mean, we got to those with those lows with actually, the other 490 names where, they reached a low point of down almost 10%. So not nearly as bad. But for a good bit, they were actually positive. So I think to me, this again just talks about the importance of diversification. You really just got to be careful, even investing in, the Mag 7, which kind of commonly known as the seven most, they're the largest companies, but they're also the ones that are kind of on the cutting edge of technology and kind of this AI revolution that we're in right now. So a lot of good things going for them, a lot of wind at the back of their sales, right? That's kind of pushing them forward. But even with those companies, you can go through some sharp declines. And if you're not building, well balanced portfolio, you could be in some pain whereby using diversification and broadening out your holdings there. Yes, it might lead to somewhat worse returns when the market's up and up in a narrowly led market like last year. But this year, that trade has worked a little bit better.
Mm-hmm. Absolutely. So, Jake, we are fundamental investors, which means that we look at the companies we're buying, like I said, not the market. And I know you and the team have been hard at work analyzing those 64% of the S&P 500 that have reported already. So, give us some of the highlights here. I know we've got 4 stocks you'd like to talk about today.
Yeah, there's a couple big names here that have reported earnings, and a couple of them have been pretty volatile after their results. I think kind of the ongoing theme has been that the last quarter results and kind of the year over year results for these businesses have been very strong. So even with the stock like Meta, where this was down almost 10% after those earnings were announced, you still had a company that was beating and exceeding their revenue expectations, and their guidance going forward for revenue and for profit also beat expectations as well. Now, we really got to dig into these earnings and into the management commentary to kind of see, what the market didn't really love about this story. I picked out a couple things. Number one is that Meta had like a one time charge that they had that really negatively impacted their earnings per share or their profit for the last quarter. So from a headline standpoint, that had a negative reaction to it. Now keep in mind that's just a one-off charge and should not be recurring. So not that big of a deal potentially. The second part of it though is that they kind of put their doubled down on their investment and their capex expectations. And this is something that Meta has been in and out of over the last couple of years now. And a lot of it started with their kind of foray into the metaverse, right? Even changing their name. And the market really was negative on their metaverse investments. A lot of cash went into it, and they didn't get a lot of profits back from it. A lot of their investments now are really going into more AI projects and not really the metaverse. But I think that investors got a little bit cautious just from feeling the pain that it wasn't too long ago when they really went down a warpath of a lot of cash burn into those investments. So that's with Meta. On the other hand, we had a stock like Amazon where the fundamentals were great, just like Meta. They had a very positive reaction where the stock was up over 12%. And really the big thing with Amazon is with AWS, which is their cloud platform. Just saw an incredible amount of growth and acceleration there. But also they tend to deal with OpenAI, which is the company that has ChatGPT, probably the most has the most momentum right within the AI space. And OpenAI signed a 7-year deal worth almost $40 billion to purchase cloud services from AWS. So right there is a lot of optimism, AWS accelerating again, and it's a very, very profitable unit of their overall business. The last two companies here, they're major parts of the global economy, major parts within the US stock market, Microsoft and JPMorgan. Both stocks were down modestly, down about 2% for the pair. And again, we saw fundamentals that were really hard to pick a lot of holes in. So with Microsoft, again, they have their own cloud platform called Azure. They saw just continued momentum there in bookings and profitability. And then with JP Morgan, strong environment from both trading avenue as well as their traditional banking services. net interest income was very positive and beat expectations. However, they did comment on kind of the overall credit environment. They booked a loss from a non-bank auto lender, and so that hurt their profitability a little bit. And they started to build a little more credit reserves too, which is kind of like their version of like a rainy day fund in case some of their loans do end up being negatively impacted and taking losses. So to me, kind of a broader sign of that the credit environment might be starting to show a little bit of cracks. Although, kind of outside of JPMorgan, it does seem like spreads are still really tight in terms of high yield spreads, which would kind of still show a picture that the credit environment is still pretty healthy. So, a lot to kind of dig through there. But I think overall, if we take a step back and look at the results, very, very strong. They paint a similar narrative to what we saw earlier in the earnings scorecard. And even with these big spikes, either up or down post earnings, we have to still remind ourselves that that the valuations of these companies are pretty high, and so expectations are strong for market participants. And we really got to be sensitive of how much we're willing to pay for each of these companies.
Yeah, yeah. Great synopsis there, Jake. Four really strong and big companies there, important to the economy. And I know we've got more work to do as earnings continue to roll in. So we'll look forward to another update next month on some more companies from you. As we finish up here, just a reminder of what should you do? How does this all apply to you? What are the action steps that we should be taking? And Jake and I sat down and we talked about these, and we actually just carried these over from last month. We thought they were that important last month, and we think they're even more important today. First and foremost, it's stick to the plan. We at FourThought lead with financial planning for all of our clients that we work with. Investments, big part of it. But the plan that we put in place for you, it includes the ups and it includes the downs. We account for that. So stick to the plan. Number two, review any debt that you currently have outstanding for opportunity to potentially refinance it. Like we talked about earlier, it's coming down slowly, so maybe not yet, but have a plan ready to go. If it hits a certain rate, when does it make sense to start refinancing? There's some opportunity there potentially. Third big one here, don't react, invest. That chart that we had that showed the Mag 7 versus the rest of the market, and Jake, your commentary around diversification could not have been more perfect for this. We are investors. We have the plans in place. When we see pullbacks, when we see improving markets, we know one of the big things is always rebalancing our portfolio to maintain the diversification, and it works out over the long run. So continue to do it. Stick to the plan. Fourth and finally there, consider locking in your fixed income allocations. We talked about it last month. We're going to keep it going this month. Rates are still pretty good. You're looking at yields on fixed income securities right around 4.5%, depending on where you are on the yield curve. That's pretty good. We would be encouraging folks to make sure you're well allocated to fixed income for your individual cash flow needs, but be locking in those rates now. Don't wait, because those will continue to come down as the Federal Reserve continues to cut rates. So that's our expectations there. So continue the rebalancing effort, focusing on that fixed income part of your portfolio. So with that, thank you all so much for joining us today. As always, if you know somebody that would benefit from hearing from Jake, myself, and the entire FourThought team, please let us know. We'd love to send them an invitation to our December version of Coffee with FourThought here. And we will go ahead and move into our question and answers. And we will see you all next month if you don't stick around for that. So thank you all very much, and we'll move over to Q&A.
All righty. Thank you so much for that, Joel. I'll go ahead and take it from here. We got a couple questions that have funneled in already. So thank you all for that. If you have any more questions, feel free to pop them in the Q&A chat down below. But the first question that we had is we talked about a handful of big technology names that have sort of led the broad S&P 500 market return, not only this year, but it was even more pronounced over the last couple of years. And one thing that we kind of hinted at would be correlate the concentration within the index. And so we had a client ask about that, sort of, what do we feel about that risk? And from a historical context, is it something we should be worried about? And kind of how is FourThought positioning for that? And so to answer that, yes, it is certainly something that we're paying attention to. As we mentioned, the S&P 500 is a market cap weighted index. And so as those companies get larger and larger relative to the other 500 companies within the index, they take up more and more of that share. And what we've seen is that historically, the concentration levels are higher today than really almost at any other point than we've seen before. So what that means is that these, handful of names, the Mag 7 names, let's call them, they have a higher and higher portion of that index, which means more of the returns come from just those 7 stocks. And also, it can be a larger risk too, as you're just getting less diversification and more of your dollars right into just those companies. Now, what I would be remiss not to mention is that these names, as kind of a cohort, are also growing extremely fast relative to the other names. They tend to have pretty high profits, and a lot of them are kind of, as I mentioned, having the wind at their sails in terms of this, being major AI companies or benefactors from that. And so one thing, though, that we are always focused on is we want to, we don't really necessarily own the index. We choose to kind of pick the companies that are represented in the index, and we can avoid certain names or we can invest in certain names. And what we try to do is broaden out the exposure to the overall market. And perhaps I'll use technology and semiconductors as an example of this. And if you look at an index like the S&P 500, or if you're looking at like a growth index, maybe the NASDAQ or the Russell 1000 growth, you'll kind of quickly see that there's only like a handful of technology or semiconductor names that have like a kind of meaningful position within the index. I mean, you've got NVIDIA, of course, you've got Broadcom, but kind of after that, it quickly dips down into like, less than 1%, let's say. What we can do is we can invest in more semiconductor names that are maybe not just, 2 large companies, even though we love those two companies. We can kind of further broaden out from those names and maybe pick up some names that are in the value chain for semiconductors or within like packaging, kind of like the pickaxe and shovels per se. So we can kind of broaden out that exposure and diversify such that if we have a belief that semiconductors will, should continue to do well as the internet kind of expands and AI initiatives increase, well, we don't have to just be beholden to 2 companies to get meaningful exposure there. So diversification's key in our mind. We kind of think it's the only quote unquote free lunch you can get in the stock market. And so that's kind of how I would use there. We certainly don't own all the Mag 7 names. We own a good bit of them, but how we're kind of playing that concentration level is, having exposure to the names we think are truly high quality businesses, and then adding some more diversification so that our portfolios aren't just driven by a handful of names. Let's see. We've got another question here, which is a little bit more broad in nature, and it's just about determining the right mix between growth and income investments. And this is a really phenomenal question. I think it kind of hits right at the heart of how we approach not only financial planning, but also how we build portfolios. And I think number one, it obviously depends on each client, right? And that's why we take a lot of time meeting with all of our clients and really trying to understand what sort of goals or financial objectives do each client have. And what we know is that we can fully basically eliminate risk in a portfolio by just investing in treasury bonds and calling it a day. But we know implicitly that over the long term, this isn't a winning strategy to beat inflation over time and then generate the return needed to meet these financial goals for each client. And so we understand we have to take some risk to achieve our goals. And the question that is really important is how much risk is right for each client. And this is a definitely a question we can kind of help answer and provide some historical context to. But ultimately, it really is client dependent because for two very similar individuals that have very similar goals, but one is much younger than the other, well, that longer time horizon can mean that that client could be willing to accept more risk because they have more time to sort of make up any losses that they might have. Or you could have two very similar clients, similar risk, similar time horizon, but one just feels very differently about experiencing any portfolio losses. So there's also, a qualitative kind of standpoint that each client has to be aware of too. But what we have to do is understand all the individual goals, kind of the total financial picture, each client's feelings about risk. And we need to invest the portfolio so that it can earn a rate of return needed to fund all of the goals. And we also then have to choose the asset mix that will hit that return target at the lowest risk. So we're not taking any additional risk other than what is absolutely necessary. So naturally, this tends to lead to a blended portfolio of stocks and bonds and one that's diversified across multiple asset classes so that we reduce the risk of the plan failing just because one asset class fell out of favor, for example. But also, when we think about growth versus income investments, we are very cash flow driven. And I think all of our clients know that with how we kind of run every meeting. And we look for companies that are growing businesses, but also have an income portion through dividends. That's a big part of our investment philosophy. So I think there is a long-term, plan that's generated, and that will kind of tell us what type of portfolio to build. And then as time goes on, we can kind of see where in the market there are opportunities. And so right now, growth has been very well rewarded and is now trading at a little bit of an expensive valuation, is what a lot of people would kind of concur. And so maybe this might tactically be a time to take some chips off the table, for example. But that's kind of a strategic allocation and then a tactical, and that's what we do here at FourThought. We're making those changes within the portfolio, and that's kind of how we arrive at those conclusions. Other than that, I think that's all the questions that we had today. So again, we just want to say thank you so much for taking time out of your day to listen to Coffee with FourThought, and thank you for the trust that you grant us. We appreciate you all. And if you have any other questions or you want to kind of reevaluate your portfolio, please feel free to reach out to us. We'd be happy to have those conversations. Thank you, and we'll see you next month.